Good morning, Vietnam. Thanks very much indeed for coming in. And we're 9 o'clock. I think we're 9 minutes past 9. So welcome to this panel. We got some very high-powered financiers here, guys running stock markets, guys running stock trading platforms. Very excited. The plan is that we'll wrap it up at around 9:45. Take about 5 minutes for questions. And, we've lost one already. And then we'll get you on your way, certainly by 5 to 10. Thanks very much indeed for coming in. I'm Andrew Bell. I'm an anchor and reporter at Business News Network. And when people see me in the flesh, they say, you're older, you're shorter than I thought you were. And so, sorry to burst anybody's bubble. Thanks very much indeed for coming in. I'm going to start on the left, because he is a Marxist. Oscar Jofre. So Oscar, is it Oscar Jofre? Jofre. He is the king of crowdfunding. He runs a technological platform that for people raising money through crowdfunding. He's the CEO of BoardSuite. They can just plug into that, and he'll provide the nuts and bolts. And he's one of the top 10 global players, or he's been hailed as that. Next to him, we've got another distinguished American guest, Cromwell Coulson. He's president and chief executive officer and director of the OTC Markets Group, Inc. They used to call the stocks that traded over the counter in the States the pink sheets. He's helped move that up market big time. They've got big international companies called Rush Limited listed on their system. They have all kinds of venture companies as well. Disclosure standards have improved markedly. Then the guy who needs no introduction, Richard Carleton of the Canadian Stock Exchange, the CSE. As you know, he runs really the third stock market in Canada, an actual stock exchange for venture companies, still pretty small, $2 billion in market cap. David Franklin, formerly of Sprott, now with WoodsWater Capital. Always great to see you, David. And then John McCoach of the TSX Venture Exchange. So thanks very much indeed for coming in, guys. Going to jump into it. We don't want a big lamentation, obviously, about the state of the resource market. We know it's pretty rough. Richard, can I start with you? Just remind us, if you would, why the retail investor is on strike and what can be done to bring them back.
Well, clearly, we had a real boom in investment in the resource industry approximately 5 years ago, when we had the big run-up in the price of gold. And unfortunately, not very many people made much money. And when you present to your investment public volatility and paper losses, that's not necessarily a good calling card for the early stage markets generally. So it's clear, and certainly everybody in the room is aware of it, that it's been a real challenge to sell the retail community on even the good stories.
John McCoach, and thanks for joining us. You have about 2,000 listings. You've got a much bigger market cap. You're north of 30 billion. But about half of your 2,000 listings are dead in the water. I mean, they're paying their listing fees, and that's about all they're doing. So how dire is the situation?
Geez, there's a lot of assumptions in that question, isn't there?
Well, they're inactive, let's say, half your listings.
No, I wouldn't say half of the listings, but absolutely, there's a number of companies that are having a challenging time, particularly last year. There's signs of improvement in the market, both with financing activity and trading activity. So I see 2014 as a much better year than 2013. But as is a normal cycle, there's some companies that are successful and others that don't make it. But the mining industry is very resilient, and most of those will fight another day.
Cromwell, thanks very much for joining us. You're with OTC Markets Group. You've helped revolutionize really the non-NASDAQ, non-NYSE trading system in the States. You like to call yourself the eBay compared to Sotheby's and Christie's. Just briefly explain what you're all about.
So, very simply, we operate financial markets for 10,000 securities. And at the very core, we came from providing technology so broker-dealers can get best execution for investors in U.S. securities. The U.S. our market is huge, and our trading community is the most technologically advanced in the world. The Citadels, the Knight KCGs, the Citigroups, the Goldman Sachs. There's an incredible backbone for trading stocks. and the giant retail brokers, and that ecosystem is a great place to be selling market technology. But as we made our markets incredibly efficient from a trading standard, and we improved the technology, the transparency, and the regulation in the space, what we also needed to do was to bring in the corporate services so the better companies could also light up the markets with their information. Because what markets do for companies is they sell trading. They also, though, they sell transparency services so investors and brokers can make informed choices. And they sell compliance processes that build trust. And so we've created 3 markets where at the bottom we've got OTC Pink, which is where brokers get the best price in risky securities, and there's tons of restrictions around all those securities for various reasons. It can be a bankrupt company, or it can be a foreign company that may not be in compliance with US laws, so a broker has a high risk selling it to investors. Those securities, it's very hard for a broker to recommend. It's very hard.
I'll have to hurry
Sorry,
you here.
yep.
I know
So,
you're a
but
passionate advocate. Just tell us
the
about
quick,
the other
and
two
then
tiers.
the other two is we've got in the middle OTC QB, which is a venture market. It's to fit a lot of the TSX venture companies. And at the top, we've got OTCQX, a best marketplace for established global and growth companies, where you can't be a penny stock. You need to meet high financial standards. You need to provide the information so brokers can be able to solicit orders and provide advice, so investment advisors can sell it into advised portfolios. And so what we've done is we've created markets to fit the needs of companies through their life cycle, from distressed to entrepreneurial to when they're in the establishment.
Oscar, I think a lot of people would argue that the traditional model where the broker phoned up her clients and said, I got an equity for you and this thing's going to go up. Of course, her underwriting department has asked her to push that particular product. Is that broken? Is that why crowdfunding, you reckon, is the coming thing?
Yes, I mean, we're seeing it already. I often use the word tsunami because it is catching the world by a massive storm, and the traditional way of raising capital is dead. We're hearing it in the United States. There's no trust for Wall Street anymore. The individual investor, retail, or even accredited investor has said, I want to do it directly. I don't need the advice. I have the know-how. I just need to be given access. And we heard this in Canada as well. And this is not just alone in the United States. In fact, Australia, UK, Italy, Asia, everywhere. This is a global phenomenon. And part of it is because it's providing an access to investors, information and companies that has never been made available to you. I truly believe, in my 10 years experience working with the listed issuer community, both from the TSXV, CNSX, OTC, and others, equity-based crowdfunding is the most transparent model that I've ever experienced.
Okay, now before, I know we're going to have a debate on that, before we move on to that, and obviously a provocative comment there. David, great to see you again. We interviewed you many times when you're with Sprott. Remind us what you're doing these days very quickly, if you would.
Sure. So there was a few, me and my few colleagues, we left to focus on natural resources from a private equity standpoint. And so private equity is a much different model than a hedge fund or mutual fund, where we're out working with larger LPs on a 10-year lockup. So you raise money and on a 10-year lockup and invest in private companies or build companies, very similar to what one of our principals did with the Sprott Resource Corp. Mm-hmm. So this is but it's a much better, in the mining space today, given the state of the nation, privately raised money on a 10-year lockup. I think the opportunity is fantastic.
And who are the clients? Are they institutions or wealthy people?
No, these are institutions, pension funds, endowments, most of them in the U.S.
John, I know you're with the Venture Exchange, but the TSX Group, TMX Group is moving towards or thinking strongly about launching an exchange, if I can call it that, for private equity or for private investments. How will that work? It sounds almost like a contradiction in terms.
Well, it's not a new concept. Shares can trade within what's generally called the closed system in the exempt market right now, and that's perfectly legal, assuming there's an exemption available to do so. So we're just providing a platform to create some visibility for that. I wouldn't say we're moving towards, as opposed to we're giving people options. So if your clients want to transact within that closed system among accredited investors, there's a transparent platform to do that. If they want to trade equities in the public markets, we offer that service obviously as well.
Richard, well, we haven't got a banker here, so we can slam the banker safely. No, we've heard a lot of participants in the resource market say the banks are in no way interested, even in equities. All they want is just bring people into these wrap programs, put them into their mutual funds, and just collect a 2% fee off them every year. Is that one of the big parts, one of the reasons for the malaise in resource investing, venture investing?
It's certainly got to be part of the puzzle. There's no doubt that, and we're not just talking about the bank dealers here, but I think through a series of perhaps individually well-intentioned measures, the regulators have significantly ramped up the risk for all dealers, independent and otherwise, advising clients to invest in the equity space. And with a fiduciary responsibility, which has been assumed but is in the process of being formally implemented, it puts a tremendous compliance risk on the dealer when they are advising clients to invest in what has to be admitted as a risky asset class. Mm-hmm. As John said, many of these companies aren't going to make it. I mean, that's the nature.
That's the idea
of this space.
Yeah.
But of course, the portfolio theory holds that a certain number of them are going to do spectacularly well, and the returns will be outsized as compared with the portfolio of companies that aren't growing so quickly. But as I say, if you look at it on a one-by-one basis, there are going to be a number of failures in that portfolio. And as I say, all dealers, not just our friends at the banks, are of course, gun-shy somewhat about recommending investment in those names.
Because the client is going to be inclined to complain.
I've never seen a client complain when they made money.
Right, yeah. David, would you talk briefly about that? I mean, we've heard market participants say the bureaucracy is killing us. Clients have to fill out 35 pages of forms. Is there anything to that?
Oh yeah, of course. I mean, one of my roles at Sprott, I was the CEO of the private wealth group dealing with individual investors, and so it is onerous. I would point out though, Andrew, there's a huge difference between oil and gas and mining at the moment. So we say natural resources, but the oil and gas market has more capital flow into it this year than ever.
Yeah, thanks for reminding us of that.
Right.
Yeah,
So really, when you talk about a shortage, we're talking about mining specifically. But as we work with some of our some juniors, and we're talking about go private transactions. It's a very onerous process, and I don't want to start an argument here, but there's a lot of support for the Canadian Stock Exchange, given the easing of the listing requirements and making it easier for these junior companies to get bootstrapped up. I think my question for the other exchanges is, how we would go down to the U.S., we would talk resource investing in the U.S., and it is extremely difficult for U.S. retail investors to access the capital markets up here. And this is from I know. This is from their view. Then they very wide bid-ask spreads, very gray market. I think tapping that other larger pool of capital could make a huge difference.
So that's a big part of what we do for Canadian companies and global companies in general. Is what we do is we take their Canadian disclosure and we connect it into and create a U.S. market with great pricing, limit order display, limit order protection. So all the U.S. broker-dealers, there's 5,000 broker-dealers in the U.S. I mean, if you want to go and visit investment managers in Canada, you go to a couple cities. To get that same percentage of U.S. assets, you'd have to go to 50 or 80 cities. So you have to meet U.S. investors electronically. It's a huge, broad distribution. So what we've focused on is making sure wherever an investor analyzes, values, or trades a security, they're getting a comparable information experience to the country's home market. And we've got this incredible arbitrage community that provides very competitive pricing. What we've seen is that the online brokers, the TD Ameritrades, the Scottrades, the Fidelities, they are all pushing the electronic market makers to trade more and more TSX and TSX names in US dollars on our platform because the investor experience gets better. Because the large broker-dealers, they will protect trades for not only the US best price, but also the Canadian best price. So the investor will either get the price they see or get price improvement, and that change is creating a much better investor experience in the US, but companies can't leave the other half of the screen empty. When an investor pulls up the US symbol, are there press releases? Did you send out your press releases with your US symbols? Is it something the broker compliance system hasn't locked down? UBS won't let, if a security is not in compliance with state blue sky regulations, their wealth advisors buy these securities. So that part of it is a change, because in the US, we have tons of retail investors. We have lots of individual investors who are out there looking for opportunities, and they all want to invest more globally. They all love overseas investing, and in our market, there's not enough stocks on the international stocks on the New York Stock Exchange or NASDAQ for them.
And Cromwell's done a great job of stepping in to solve the problem that David alluded to. Mm-hmm. But it's a shame that we have that problem, that the border isn't more, there isn't more free flow of capital coming from the United States to support our Canadian companies. And we're doing what we can to help that.
What's the main thing blocking it, do you think, John?
There's not one main thing, but it's largely the broker-dealers in the U.S.'s business models. There's regulatory issues. There's just people's comfort level in dealing within their own country.
It's a million little things.
Yeah.
Okay. So you build the connectivity and you think, okay, I've got the connectivity. And then you say, oh, what else is blocking it? Where else is this? What else is missing? So you're layering in. And at the top level, Roche's ADR, most investors who buy Roche that trades on OTCQX, they can't tell the difference as if Roche was on NASDAQ or New York Stock Exchange.
And we should remind, Roche, the giant Swiss drug company, it lists with you.
Yes.
Because they literally do not want to report using U.S. standards, because they say we don't do our business that way. We don't need to get our head around it.
Well, they're a Swiss national champion, and they comply with they sell drugs, so they comply with lots of regulations around the world. But they're also very cognizant of making mistakes, and they know their management team, their system controls, knows Swiss accounting, knows Swiss governance, so they want to meet one regulatory standard as a Swiss company, but be a global company of how their information and products be distributed everywhere. And that's what we've opened up. Because in trading stocks, you really just have to be in your home market and the US, and everybody else in the world has access to you. And that's a pretty incredible spot of we've created, instead of trying to say, okay, we want to have these global champions or these emerging growth companies become American companies. No, we want them to stay national champions in their own market, but provide a consistent and comparable information and trading experience to U.S. investors through their U.S. brokers.
Okay, Richard, you look like...
I was going to say, and that's something actually that people in the audience should be aware of, that, and it's great for the Roches of the world, it's also great for the companies that are listed on the Canadian Securities Exchange. Because we were recently, this year, recognized as a foreign exchange by Mr. Cromwell's organization. And at this point, about half of our companies have actually stepped up to engage with the increased distribution, disclosure, and provision of company fundamental information and so on. And combined with the fact that the big U.S. market makers are, generally speaking, providing quotations for what we think of as non-interlisted Canadian stocks, there is an opportunity for Canadian companies to have visibility, to get U.S. shareholding, and potentially, and we may get to this if we don't run out of time, the opportunity to even raise money in the United States under the Jobs Act, by virtue of this link. So it's been hugely important for tightening spreads, increasing the number of the people in the crowd, and overall share turnover.
Well, that's a neat segue. Let's get on to the crowdfunding smackdown that we've promised the audience. Now, Oscar, you're here to tell us that you've said the old model is broken, the old model of raising equity. You're here to say investors want to go direct. That's the way of the 21st century. Bypass brokers, bypass stock exchanges, and essentially do business almost with the issuer themselves. Is that the essence of crowdfunding?
It is, but the broker-dealer is still involved, which is really important. I mean, obviously, we want to make sure the issuers are compliant with the regulations that are occurring. So just to give you a little bit of framework, why is crowdfunding taking this massive effect globally? There are two fundamentals about crowdfunding that's really important, and it will allude to my comments. One, and it's best said by the creators of the Jobs Act, Jason Best. It does two things. It creates deal flow of innovation and deal flow of talent. And I'm going to bring those two terms up in my points here. Those two things are driving crowdfunding in the massive scale. Today, just to give you an idea, there are 3,500 Canadian companies crowdfunding. These are privately held companies in the United States. So what I said deal flow of innovation and deal flow of talent. That means that brain drain that we've been talking about is going to happen even faster. Another statistic you should be aware of, people often say crowdfunding is those $10 and $20. Title II went live September the 23rd in the United States. $30 billion has been raised from September the 23rd to May the 30th. $30 billion. 61% of that money went into real estate, 37% into healthcare, 12% in consumer goods, 8% into technology. So we are seeing where the investors are putting the money into the markets every single day. There are 350 equity crowdfunding portals in the United States.
And you have to take a look at it, why the Jobs Act is really important. Suppose if you wanted to sell your house and you went to your real estate broker and they said, yeah, that's great, but I can't put a picture of it on my website. I can't print up any brochures, and I'm only going to be able to tell some people who I've got a previous relationship with, and they've got to sign a confidentiality agreement. And do you think you'd sell your house for a very good price? That's how we raise capital privately in the United States. And the ban on general solicitation and advertising was really a requirement of confidentiality. So what we've done is Congress blew out with the Jobs Act to allow more transparency and more diverse ways to raise capital across the spectrum. This change is going to drive, because you're going to have broader capital raises, more information distribution, and smaller chunks invested in, and that is going to bring in technology, because technology in capital markets only comes when the number of transactions is going up, or people are trying to do transactions at lower costs. And that's, and that side is what we've seen in secondary trading, the technology that's driven by E-Trade, by TD Ameritrade, by Scottrade, to make it so you can trade in equity for $7.95 in the US is unbelievable. And that technology stack is going to come to the capital raising. And that is going to be very transformative in the US.
So, Richard, in my naivety, I think of crowdfunding as I've got a business, I've got a coffee shop, and then I just raise $500 from a whole bunch of people. I don't give them a prospectus, I don't give them disclosure. They're giving me the money on trust. Is that too crude a definition?
Well, I'm all for crowdfunding to, fund your coffee shop, to keep the pandas at the Toronto Zoo for another couple of months, or to keep the Toronto Symphony Orchestra in business. Don't give them equity, right? Give them a T-shirt, give them a baseball cap. My view is that the Canadian regulators have gone off in a direction, and they put crowdfunding kind of in a box, and that we should in fact be doing more along the lines of what's happened in the United States, which is to provide crowdfunding, or whatever you want to call it, as a tool in the kit of the existing infrastructure that we have, world-leading infrastructure to raise capital for early-stage companies. I mean, here we have all of this, prospectus requirements. We've got continuous disclosure, which is managed. We've got stock exchange regulations for the companies that we administer. Why shouldn't those companies be able to take advantage of those enhanced means of raising capital, right? To be able to break the, Cromwell's perfect example of the, you can only sell stuff to people that you have a previous relationship with, and they have to sign a confidence. I mean, that's the exempt market. That's too small. We should be able to permit or find a way to let everybody participate in these growth stories.
So, hang on. So, concerns have been raised about crowdfunding, people getting equity, akin to a stock. You have concerns about that, though?
Absolutely.
You think the existing system's okay?
Well, I think the existing system should be expanded to give the dealers the ability to participate and use these tools to expand the range of potential investors in these stories.
But most companies don't want to go public. I mean, we're privately held. We just want to raise our capital, grow. If you're issuing equity to a group of people of more than 150 odd, you're public. Or else you should be public, and you should be subject to I disagree
the
with
continuous
that.
disclosure requirements that we've got in place.
disagree.
Otherwise, you're absolutely opening up a fraud and God knows what else.
And I'll say to point to
Okay,
the
go
fraud,
for it,
because that's
Oscar.
often the first word, and I'm glad he brought it up because it needs to be dealt with. In Australia, which is an equivalent size of our country, their very first equity crowdfunding portal has been operating now for 10 years. 10 years. It has helped startup companies raise $135 million. Zero fraud. 85% of the companies are still in business, and they're all privately held. This is the model that the whole world is embracing. It's happening. The old model is gone. There are more companies raising money privately than there are publicly listed issuers. That's the reality. That's not me saying it. That's just, you just have to type in the word equity-based crowdfunding. You'll see the portals. They got 20, 30 listings, and they're raising their money. Hundreds, if not thousands of shareholders. These are accredited investors at the moment. That just also be mentioned that the only type of investor today allowed to invest in equity-based crowdfunding is the accredited. The regulators haven't yet opened it up to the general public. And when they do, that's just going to grow. So it has nothing to do with what I'm saying. It's what's happening. The crowd is reacting. The crowd is telling us enough is enough.
Yeah.
The days of going to your broker, they're not giving any advice. I hear this every single day from mining companies, tech companies. I go to my broker, he does nothing. The exempt market dealer, he goes to his Rolodex of 10 guys or goes out on Thursday night and talks about it. Crowdfunding fundamentally changes that, and it is more transparent, and we have proof that it is a zero fraud. Do not mistake this with rewards-based crowdfunding. Equity-based crowdfunding is regulated, should be regulated, and those involved embrace it.
So I would say I'm hanging out in the middle because I actually think the most important thing is to give lots of choices for companies. Now, if you're a small investor and you invest in a private company, you're stuck. Your only thing you can do is hope someone buys the company, or the company buys you out. You are by default an activist investor. And so all of these crowdfundings, whether they're raising it for private or publicly, eventually they're going to want to become public, because the great thing of public markets, and they get a bad name, but the most sustainable and successful companies are public companies. We're a public company, we're traded on our market, and I can tell you, if I get hit by a taxi walking out of here, my business is going to still keep going. I've got a board of governors, a management team, my shareholders, and that's a really important part of building a sustainable business. But as an entrepreneur, when you're starting out early stage, maybe you shouldn't be public because it takes a couple years to actually get a bit of a business. But once you do, you want to be public because you're getting perpetual capital and you're increasing the value of your investors' shares. Because the easiest way to make a piece of property more valuable is to make it transferable, to make it saleable. The easiest way to help your successful business become more successful is to be transparent. is because transparency builds trust. It helps people understand your business model. So the whole crowdfunding world, I don't really care if they're public now or they're public later, because the coffee shop's probably never going public, but there will be successful companies, and they will want to get the value of being public so that they have perpetual capital and build a sustainable business.
David, what do you think? I mean, Oscar characterized crowdfunding there as something pretty similar to private equity, but in a much more structured way and accessing a far bigger pool of investors. What's your thought there?
Well, I mean, I've never participated in one as a broker and a CEO of a brokerage UDP role. I could never imagine myself recommending to a client to do a crowdsourcing form of funding. As a way for early businesses to bootstrap, I would 100% agree that I think that's a good approach. But as a professional investor or as a professional providing professional advice, I can't imagine where at any point in time where I would say that's a good thing for a client.
What worries you? The lack of disclosure?
100% the lack of disclosure.
Well, I'll mention it.
Well, no, it's the lack of disclosure would be the biggest thing.
And the lack of liquidity.
And the lack of liquidity.
As Cromwell says.
The TSX Venture, as I've gone around the world in Hong Kong, Australia, the CPC program, I think, should be replicated around the world.
What program is that, David? Sorry.
The Capital Pool Corporation.
Okay, where you can list a shell, basically, and then take over an active business.
That's right.
Okay, yeah,
That's
carry
right.
on.
That's
Sorry,
right.
yeah.
And I've used that process many times. I have investors that have used that process. I have companies that have used that process. And it's a very efficient process to go public. So, crowdsourcing, great, get off the ground, but in the interest of disclosure and investor knowledge, I think going public is the ultimate way.
Oscar, I know you're dying to talk. I just want to hear from John for one second, then we'll get
just-
back to you.
And
Yeah.
Andrew, I told you before, I was happy to watch the debate on crowdfunding because our position isn't really more akin to Cromwell's actually, and but I wouldn't want to leave this audience with the impression that crowdfunding has eclipsed the capital markets, because that's simply not true. In Canada, equity crowdfunding isn't illegal, and it's only coming into play right now in the United States.
That's wrong. That's incorrect.
Well, there's an exempt market, and you can access the exempt market in many different ways, but there's no crowdfunding exemption to raise equity capital right now. And it may have its place. It's one of many tools, as was said earlier, for companies to access capital with the right controls, because we can't risk the reputation of the capital markets by blowing it open on an unregulated way. So.
Oscar?
Yeah, thank you. You can imagine I got lots of energy for you. I get very excited about this topic because fraud, disclosures, coming from a governance background. So first of all, equity crowdfunding is regulated by securities regulators worldwide. In every jurisdiction, they're involved. In the United States, I praise the SEC and FINRA for their thoughtfulness in order to not only create a framework, which, by the way, countries in Asia are adopting and other jurisdictions because it's beautiful. It outlines exactly how it needs to be operated, how it needs to protecting the investor. None of this switching eyeballs and stuff like that. It's operated by a FINRA dealer. So you want to know about private equity, Goldman Sachs, they're the ones owning these equity crowdfunding portals. Mark Andreessen, who is a multi-billion-dollar private equity fund in the United States, probably owns one of the largest equity crowdfunding portals in the US right now. Google has invested over $1.3 billion into equity crowdfunding infrastructure platforms. So real money is there, and they are correct. In Canada, we are lagging because we're using these words that it's illegal. It is incorrect. In Canada, I am now doing trade events where I speak to lawyers to remind them of two regulations this country already has that are very similar to what Cromwell was saying. The United States actually had to amend what we already had for the accredited investor. And they marketed it perfectly. The Title II We've always had the accredited investor exemption, where a broker-dealer or an exempt market dealer can actually sell securities over the web, and they still need to do due diligence. So that's available in Canada. But we have something else that's even more powerful, the offering memorandum. The offering memorandum is a rare gem. We are the only country in the world that actually offers this. Yes, it's not available in Ontario, coming soon. I agree with Richard that we need to push the regulators in that and harmonize it, but the point is we have it. The BC Securities Commission, Alberta Securities Commission last year in November and December went out, why do we need equity crowdfunding exemption when it's already there? Use it. And we have an equity portal today in Calgary called CEDUPS operating. Embrace it. It's happening. It's going to take a while. And as far as liquidity is concerned, OTC Cromwell is one of the first stock exchanges that's gone out and indicated it's a natural fitting for a private company to go through this phase. I think what the TSX is also doing with our private capital markets, it's also great. And Equitas, we're going to have choices. Those choices weren't there before for private companies.
And this, fundamentally, the world is changing where, when I started in the business, the only way you got investment information was through the mail, face-to-face, or over the phone. I mean, think about how unbelievably terrible an experience a retail investor had, and most institutions. So, Warren Buffett's core skill set was just reading annual reports, and he did fine. And he's also really good at calling up brokers and negotiating aggressively. But nobody talks about that, the handling part of it. But as you look at how the change and how we've leveled the playing field with information, so I'm not sure we're ever going to have the broker coming back recommending to investors. I think instead we're going to have this great amount of information for investors to make their own choices. And what we're trying to do more of markets is confirm who someone is on either side. And the equity world, I mean, if you look at what we've done with online lending, a small business can go instantly online and raise 50 grand of debt financing with these systems that go through, do a credit check, they look at how many FedEx deliveries that you have. They go through all these different data sources to deliver new credit. And, and that's going to take place in the equity space too. But it's going to be a different experience. You can't go to the traditional channel and say, okay, we're going to get a whole bunch of brokers to go out and recommend this security is. We have to feed the information into the system so the investors can make intelligent choices, that they can have confidence that the information is there. And that changes, where a marketing manager of a product would be in a supermarket trying to do taste tests between Coca-Cola and Pepsi. Now they're on Facebook, they're on Twitter. They've got advertisements on TV. They've got all these electronic channels to bring in the consumer. And that, and I think that is the market, is the future is a screen-based experience and with face-to-face meetings to build trust, but some of that delivered electronically. And that's my view of where it's going.
I think we're in sum up mood. Give us your final thoughts, Richard, please.
Guess I got the first word and then not the last word. Yeah, fundamentally, it is about the cost of capital. And I guess my frustration, and I was, having it on with Oscar just for a little bit of fun, but my frustration, I guess, with how things are unfolding here in Ontario and Canada generally is we do have a distressed community of companies and of the support network, through the dealers and the investment advisors. And, the pace of regulatory change to attempt to address those issues has been glacial. Oscar mentioned the failure by Ontario to move quickly to adopt the offering memorandum. Exemption, the rights offering notion, we're a year in on a proposal that nobody objected to, and we still haven't seen legislation or any promise of legislation on that initiative. And the direction on crowdfunding is deeply frustrating because it's attempting to put it off in a box in the corner and keep the traditional dealer community away from it. Well, it just doesn't seem to me to be the right answer. We need to be providing industry participants with all of the tools in the kit in order to, as I say, provide the lowest cost of capital for the companies.
David, give us a final thought if you would.
Sure. Well, I guess the title of this was "Where's the Money?" From our experience in the last year, there's huge pools of capital in the U.S. that are looking for new opportunities. When you sit across from a pension fund, their portfolio was up, their equity portfolio was up 30% last year. Mm-hmm. Their bond portfolio was up 15%. And they now have new capital to allocate, and in the real asset space, the best opportunity is in mining. It's almost a depression. However, accessing that pool of capital or getting those dollars up here proves very difficult for them. We're not seeing offerings of securities down there. But they're very interested in tapping that pool. There's $8 billion now sitting on the sideline in private equity amongst different private equity pools, looking for natural resource opportunities. So that's where the money is. And I would put it out to my friends on the exchanges. If you can make it easier or simpler for these to tap that pool, I think we're not going to see these 50% of these companies drop off the venture. And the ASX yesterday said they have a third of their listings in mining are the same risk.
John, you're the venture exchange companies. They've raised something like $3.5 billion this year, and it was only around $3 billion for all of last year. About a third of the money, I think, is oil and gas. So it's not all oil and gloom, oil and gloom, doom and gloom.
No, not at all. I'm of course very concerned about our customers that are having a challenging time, and there's a number of them. But I'm also very proud of the ones that have raised a lot of money and have been very successful and graduated to the Toronto Stock Exchange, been part of the the S&P TSX index and the biggest companies in Canada. So I think we always have to remember, markets cycles are challenging, but we still have the best infrastructure in the world to support early stage companies. I go out and I talk to fund managers literally around the world, talk to other stock exchanges, dealers, and they really envy what Canada has. And it was a tough, 2013 really sucked. But relative to what happened in the mining industry in Australia, in South Africa, even in London, we fared well. That doesn't help the companies that really suffered, but it does give us optimism and hope for the future that this infrastructure will survive, it will thrive, and will end. And with working with the regulators, I agree with you, Richard. I wish it moved faster. It frustrates me sometimes, but I've actually never seen an environment where the regulators are more open-minded to new ideas, like the existing shareholder exemption, which I think was what you were referring to. That it took them a long time to come around to that, but they did eventually. We are working with them on improving the traditional rights offering programs. There are other exemptions they're looking at. So they've the CSA just announced a proportionate regulation proposals. I hope people here will look at it because those will help our market. So I'm really looking forward to 2015.
On that note, thank you very much, gentlemen. Oscar Jofre was on the far left, President and CEO of BoardSuite. We were also joined by Cromwell Coulson of OTC Markets Group, Richard Carleton, the one and only, of the Canadian Stock Exchange, David Franklin, WoodsWater Capital, and John McCoach of the TSX Venture Exchange. Can we have a big hand for our panelists, please? Now, I think we've got about 5 minutes for questions. Go. John Kaiser has a question. Go ahead, John.
Almost all the trillion-plus issued shares are publicly listed and in compliance with regulations. Companies in the United States were issued to a tiny minority of the population called insiders and accredited investors. What is the moral justification for a system that restricts the rest of the population, known as the retail investor, to buying as much stock as they want through, say, a discount brokerage account in the public markets to a point of blowing their brains out, but they are forbidden from giving money directly to the companies in the form of a private placement.
So, okay, John's question there was that the retail investor doesn't get a fair shake because they can lose money buying stock in the discount brokerage, for example.
No, they can buy publicly traded
Yes.
stock to their heart's content, provided they don't have a broker who now forbids them from doing so.
Okay.
But they cannot give their money directly to the company. This is the biggest problem facing at least the junior sector right now, is the pipeline of capital into the treasuries is plugged because the institutions aren't here. The accredited investors, at least in Canada, are a tiny pool, and the retail public is forbidden from putting money into treasuries through private placements. The accredited investor definition says you have to be worth $1 million net, not including your home real estate. The audience has been cut out from giving money to keep these companies alive and flourishing.
So John would like to see really a much broader definition of accredited investor.
But we're allowed this way, and there's no moral justification for it unless I'm not seeing it.
But there's the offering,
Yeah.
there's the offering memorandum, which, as I said, it's a fantastic exemption. And part of the problem with any exempt market that Richard pointed out to, it is sold through exempt market dealers in Canada and basically go through their Rolodex and that's it. Where Cromwell stated that in the United States, everything's electronic. So I'm with you. The everyday investor is screaming exactly the words you're saying. I want access. I want to be able to get in that early stage part. So how do I do it? I qualify. Why am I not getting it? And by the way, there's a lot of accredited investors in Canada. 1.2 million with the same crime file, because the same 200,000 accredited investors are always on the same play. So the only way that's going to change, the only way this is going to change is where this information is made available to you in an electronic format. And the traditional way of doing it, where I pick up the phone, is dead.
You know, it's just one side of it is there's a lot more in the U.S. The accredited investors and institutions are considered that they're smart enough to do their own research, know their own risks. And for the retail investor, they need protections if the broker is advising them to do something. So where trading is, you say, yes, they can go trade their account to zero, the broker gets in trouble if they've been advising the client to do that. So what's happened is the tools have been created for investors to trade themselves. And you know, there aren't brokers recommending small stocks as much because investors aren't asking brokers to recommend small stocks. They're doing the research themselves. So what's going to happen with crowdfunding, and it really depends, you know, which of the parts, because the accredited one is the one they opened up the quickest, and we're seeing a lot of activity in the U.S. because we have a lot of accrediteds. But if crowdfunding works, if Reg A Plus works, which is an offering which will be open to every investor, and it's open only to U.S. and Canadian companies to use. If that gets approved in the next 6 months, we're going to have some huge changes where that takes place, and we're going to see the internet model where instead of being sold a security, the investor is finding one, researching one. And these are the places, I mean, I actually think public markets, whether it's our QX market, you know, the CSE, the Toronto Stock Exchange's markets, they're a great way for companies to show they've met standards, to show so you're going to have a lower cost of capital if you've gone through this process versus a private company. There's going to be a bit more risk there, you know, and if you're a company and you've been publishing your disclosure for a couple of years, you're going to have a track record. That's how you build trust. You don't suddenly show up with one offering document and say, look how great I am today. Is what you do is you execute. So I think we're going to see the changes where more investors have access. It's not going to happen next week, but in 5 years, we're going to be in a real different place for capital formation.
John?
In Canada, it actually happened in the summer where the CSA, other than Ontario, which is about to introduce the same exemption, introduced the existing shareholder exemption, which we've been pounding the table on for 3 years. But it does exactly what you're talking about, John, in that all of you, if you're not accredited investors, this looks like a pretty wealthy crowd, Andrew, so they're probably all accredited. But if you're not, and you see a company you're a shareholder of doing a financing, call them up. say, I'd like to participate in that, there's an exemption available for me to participate as an existing shareholder. And as I say, Ontario's hopefully about to introduce that. It's available right now in the rest of Canada.
I think we're going to have to bail. Let's get one more question. Sir, go ahead. Very quickly. Angel investing, okay. David Franklin, is there room for angel investors in natural resources?
You mentioned oil and gas. I think, there's lots of room. I would say, of course, right? Of course. These companies are starving for capital. So is there room for angels at the moment? Absolutely. When the market rebounds, I think you get crowded out by institutions, but at the moment, I can't imagine one of the 1,400 companies on the venture saying no to an angel.
Sir, what's your question, sir, very quickly? Sorry, what was that question? The next month?
We're starting a private market platform, is that?
Okay. Thanks.
Yeah, it's, I don't want to predict a date. It's just literally dealing with paperwork right now and, finalizing forms and things like that. But it's going to be in the next few weeks. Yeah. Well, it'll also be a platform for public companies to access capital as well as private.
Okay, sorry, I kind of lose. So what was the main point you were making there? Oh, excellent. Thanks very much. Okay. Listen, I think we're going to have to leave it there. Thank you for coming. I got to get back. I got to do a show. But I'm sure the guys would be happy to answer your questions offline, as they say. Thanks very much. Can we have another big hand for our panel?